Andrew, I've got to go back to what's held up the market, which is use of cash. I mean, it's a global use of cash. You have an important global sell on equities. Doesn't that push against sustained dividend growth and particularly share buyback, whether good or ill?
Sure. So look, I mean, dividends and share buybacks have clearly been supporting global equity markets, but I think there are short-term and longer-term, I think issues with counting on too much support from that. First, we're entering into earnings season where companies enter blackouts, where that buyback activity dissipates. So in the very near term, markets are going to lose some of that support. I think the other element is that companies, I think, respond to market conditions and economic conditions just like investors do. So as long as there's confidence in central banks and confidence that global growth will be okay, companies will continue to buy back stock. But I think it's one of those supports that when you see growth fears pick up, and our economists have been downgrading their growth outlook, companies also retrench and they take a pause. And, we've had a number of quite sharp sell-offs, including, if you think back to November and December this year, when in theory there was still heavy buyback activity going on. So it certainly is something that helps the equity market that we need to respect, but we don't think it's something that makes equities a hold or a buy here.
Ellen Zentner and your economic team have been lights out on tepid economic growth. Is the arching issue of your global sell on equities weak nominal GDP, not a global recession and all the fanciness there, but just a more tepid, dampened global nominal GDP?
It is. I think it's partly that. I think it's partly that markets are already expecting, we think, a pretty aggressive central bank response, which, probably minimizes and reduces the effectiveness of that in boosting markets. It's the fact, I think, from a micro standpoint, bottom up, we're below consensus on earnings over the next 18 months, which is partially to do with that weak nominal GDP outlook, but it's also based on the margin pressure that we see in a number of markets, including in the U.S. And in parts of Asia, which we also think will weigh on earnings.